You've reviewed your pensions recently and you've seen that you're in something called a with profits fund, and you don't know what a with profits fund is, you don't understand it, and you don't know whether you should stay in the fund or switch out of it. I'm Andrew Neligan, and in this video I'm going to explain to you what a with profits fund is, a bit about their background and how they work, and then reasons why you may stay in the fund and reasons why you may switch out of the with profits fund. Please note that there's a generic information and guidance. It's not a personal recommendation, so please don't take it as such. If you want specific advice to your situation, please do get in contact. But let's get on with the presentation. Let's get into it, and I'll explain what a with profits fund is first of all. So with profits fund is a cautious approach to investing your pension. It used to be there were investment products as well and endowments, but mostly these days it's legacy pension funds, deferred pensions that you might have. And the aim of a with profits fund is to benefit from the returns of the underlying assets within the fund, so investing in the global investment markets, but without the ups and downs of stock market investing. So if you think back to the cost of living crisis and the invasion of Ukraine by Russia, and the high rises of interest rates when the investment markets around the world plummeted, or the start of COVID when we had similar levels of stock market falls, the aims of a with profits fund is to take out those big stock market swings. So rather than every year when you look at the value of your pension, you see those ups and downs in the value, every year a bonus gets applied, and the bonus is called either an annual bonus or a reversionary bonus, and it's declared each year, sometimes on a 6 monthly basis. So the pension provider, the with profits fund, declares the bonus rate and applies that bonus to your pension. So a typical with profits fund will be a mix of assets. This is just a representation, doesn't show a specific with profit fund, but it will be mostly lower risk assets because it's cautious. So that will be fixed interest securities, which are government bonds or high quality corporate bonds. There'll be some shares in there, usually predominantly UK stock markets, but with global stock markets as well. Some commercial property, so that think they're office blocks, retail shopping centres, distribution centres, that sort of commercial property, again predominantly in the UK, and then there'll be an element of cash. And the underlying fund will rise and fall each year, depending on how those underlying investments perform in the global markets. But as I said, the point is that you get this smooth return, this taking away of the volatility of investing. When I say volatility is just jargon for how much something goes up and down. So this curved line here, it denotes the returns that you'd get from a normal investment if you were outside of with profits. So every year you'd see the value go up and down. Over a long term, you'd expect to see higher returns, but in the short term, anything can happen, as we've experienced. And so the straight line represents the with profits fund and the application of those annual bonuses each year to give you that smoothed return. So in the good year, or the good years, the with profits companies, the pension providers, hold back some of those returns, and in the bad years, in the years of falling markets, they give some of those returns back to you as the investor. And so when you get to the end of your time in the fund, either because you've reached retirement and you want to take your pension benefits, or you've decided to move your pension elsewhere, so you switch out of the fund, or you might stay with the incumbent pension provider, but you just want to switch out of with profits, one of two things may apply. You hopefully will get something called a final or terminal bonus. And what that represents is your fair share in the performance of the underlying fund in the period that you've been invested. So you've had the annual bonuses applied each year, then you get a top up, a bonus, to give you back what you've missed out on while you've been invested. Now, that final bonus isn't guaranteed. It can be reduced and it can be taken away. And the opposite side of the coin to the terminal bonus or the final bonus is something called a market value reduction, MVR, or market value adjustment, MVA, two terms for the same thing. And when they get applied, it's because the underlying fund will have gone through a period of market losses, so it's lost value, and the with profits company have got to make sure that anyone leaving the fund at that point doesn't take more than they're entitled to, thereby penalising anyone else who is staying in the fund. So the market value reduction is a penalty, a reduction, as the name implies, on the value of the investments. So you'll see the value of the underlying fund plus a penalty. So it's a penalty applied when you leave the fund. So if you don't know your situation, how it applies at the moment, if you look at your annual pension statement, it should say the underlying value of the fund, of your fund, plus whether you've got a terminal bonus applying or a market value adjustment applying. Sometimes you can actually see both applying. But that's basically how a with profits fund works. So how did you end up in with profits fund? Well, with profits were popular 20, 30, 40 years ago in the 80s, 90s and early 2000s. And it was a default approach for many pensions, investments and endowments. So if you didn't make an active decision about how you're going to invest when you opened up an investment or a pension product, you'd have probably just ended up in there. And because of the principle behind them, they were great in theory, and bonus rates being applied back in the 80s and 90s were around 5-6%, if not a bit more. So for a cautious fund as an investor, that's a great return that you're getting for not much risk. But then 2000 to 2003 happened. And if you think back to that time, the tech bubble burst, which sent the global markets falling. Then we had 9/11 into the second Iraq war. So from a volatility perspective, it was a really bad time for investors in the stock markets, including with profits funds. And what with profits providers realized is that they were being far too generous on their bonus rates previously, and they couldn't afford to maintain them. So they very quickly applied market value reductions to protect the fund from everyone who was leaving at that time, and they severely reduced the bonus rates that they are on offer down to 0.5% at the extremes, maybe a bit lower, sometimes like 0.25%, or at best maybe 1 or 2%. They've since come up a little bit since then, but certainly not to the highs they were at in the 80s and 90s before that volatility hit. But since then, there's still billions invested remaining in the with profits fund, and on the basis that you're watching this video, it's quite possible that, or probable that you're in a with profits fund yourself. So therefore, should you remain in a with profits fund, or are you better switching out of it? Well, the reasons to come out of a with profits fund are because they have very low transparency. It's very hard to know how you're invested, and the charges aren't declared, so you don't know what you're paying to be in that fund. And as we've seen and I've explained, you are receiving potentially lower returns than you would be if you just invested in funds outside of with profits and just accepting the annual ups and downs that you experience in the stock markets and investment markets generally. It might be that you want to capture the final bonus now in case it gets removed in the future. Of course, there's always a chance that if you take it now, it will be higher in the future. We just don't know. But if you've moved out of the fund in that time, you wouldn't know what it will be in the future. But that might be a reason to take it just in case it gets removed in the future. And it might be simply your situation and needs a change. It might be you've come up to retirement and you want to start taking your benefits, at which point you'd have to come out of the with profits fund anyway. Or it might be you've just decided you're prepared to take a bit more risk and are happy to give up on that smooth returns. Reasons to stay in a with profits fund are that you may have a number of guarantees applying in the fund. That might be a guaranteed growth rate, which is higher than the current annual reversionary bonuses that are being applied. I've seen ones recently where you can get a guaranteed rate of 4% and even 5% per annum. So still for a low risk fund, that's worth taking. And that's just a legacy of the offer that was available when these people started in the with profits fund. You also get guaranteed annuity rates. And so that is a promise to pay a fixed income in retirement, an annuity, at a level that is higher than you would get if you bought an annuity on the open market. So that is a really good reason to stay in the fund. And as an aside, it was the guaranteed annuity rate promises that did for Equitable Life all those years ago. If you remember the scandal that happened with Equitable Life when it went bust, costing millions of pension savers and investors a lot of their money. Another reason to stay in the fund is there's often a guaranteed minimum fund size. So there's a floor on what the value of the fund will reduce to if we go through really bad stock market events. So if you want that cushion, you might feel protected by having that and staying in the fund. Often though, that floor is so much lower than the value of the current value of your pension fund that it would really take a catastrophe to fall to that level if you are outside of with profits. And I mentioned earlier the market value adjustment. It might be that if you look at the fund now that you're invested in, there is a market value adjustment applying. So if you left it, you would get a reduction in your pot on the transfer value. So that might be a reason to keep an eye on it and stay for a year or two until that market value reduction gets removed. Or it may simply be you just prefer that certainty of returns. You know you're giving up potentially higher returns, but you're not prepared to take the risk, or you can't afford to. So you're happy with staying with it for the foreseeable future, perhaps until you get to retirement. So in summary, with profits as a legacy investment option, mostly in pensions these days, but it applies to some investment products and endowments as well. It's no longer suitable to many investors within the fund, but do be careful about giving up guarantees or paying a penalty if you decide to switch out. So if you want to know more, please go to my website, neliganfinancial.co.uk, where there's lots of articles about investing and pensions generally and about retirement planning. You can get in touch with me there as well if you want to discuss your situation. If you've found this video to be of interest, of benefit, please do subscribe to receive an update when I post new videos. Please do comment as well if you've got a particular view or experience with profits. And also please do like the video as well if you think it is worthy. But thanks for listening.